of the call. This call is being recorded, so if you do have any objections, please disconnect. So with that, I'd like to go ahead and turn the call over to our Vice President of Servicer Relationship Performance Management, Don Griffin. Don?
Thanks, Baha. Good afternoon, everyone. Welcome to the Servicer Information Session. Hope you had a very restful and enjoyable 4th of July break. I know I did. This is Don Griffin from Servicer Relationship and Performance Management. And we're going to change up the agenda a little bit today. We're going to focus on a demonstration of how to input a COVID-19 payment deferral into Workout Prospector. And to do that, Gavin Givens from our Single Family Operations Group will walk us through that demo. So let me turn it over to Gavin.
Sure. Thank you, Don. All right. Good afternoon, everyone. So today, as Don mentioned, we're going to walk through a COVID-19 payment deferral submission and Workout Prospector. Unfortunately, this is a screenshot view essentially of WP, so it's not essentially a live example, but the screenshots will definitely get the job done here. So they want to just go over really quickly, the WP user guide will be updated tomorrow, I believe, to reflect the COVID-19 payment deferral as well as the just standard 2-month payment deferral. So if there's maybe any details missed on this call, servicers can also reference the Workout Prospector Users Guide as well for maybe any details that aren't covered on the call today. With that said, we can jump right into it. So the first step essentially to model and approve and settle a COVID-19 payment deferral is to actually sign on to Servicing Gateway. So Workout Prospector is within the Servicing Gateway tool. You're going to log in using your single sign-on ID and password. Once you've gotten into Servicing Gateway, we're going to go under the Tools section, and then you would just select Open under Workout Prospector. So we can go to the next slide here. Yep, and there it is right there, Workout Prospector. So once you've actually logged into Workout Prospector, here's your main page, the main home page within WP. As I mentioned before, the WP user guide will be updated tomorrow to reflect the COVID-19 payment deferral changes and step-by-step process, as well as the standard 2-month payment deferral. And just a note, obviously, just as with any workout, whether it's a modification or a short sale or a third-party sale, those all need to be processed within Workout Prospector. So once the payment deferral is finalized, those terms can be entered into WP and submitted to us for settlement. So the first step would be to enter the 9-digit loan number into Workout Prospector, and then you would select Enter. Yep, there we go. Select Enter. And then from here in the workout option field, we would want to go to the drop down and select Retention Program. And then from the modification type drop down, I know it's not a modification, but this is just where the payment deferral is stored. You would click on the Select Modification Type field, and then within the drop down, there's Payment Deferral. And then you would select Submit. So now we're actually in the model here, what's known as the payment deferral model. As you can see in the top, the modification status is in draft status. So what this means is basically all these fields, with the exception of a couple that Freddie Mac pre-populates, all of these fields are editable. So, excuse me, in the event that anything, you may have accidentally entered something incorrectly, you can make the change, and as long as the loan is in draft status. So a couple things I want to point out here. Obviously, any field with a red asterisk needs to have a value. However, I did want to point out just a couple of pretty important fields here under the current mortgage attributes screen. First one being is going to be the current UPB field. Now this would be the UPB at evaluation. We want to make sure that we have the UPB at evaluation when the borrower is being evaluated for the payment deferral in this field. And then we also want to make sure that we have the corresponding current last paid installment date, also known as the DDLPI, that corresponds with that current UPB. So in this example, we have $160,697.62, and then a 3/1/2020 DDLPI. The last field that I want to point out is a pretty crucial field, obviously, that we want to make sure we double check and confirm is correct, is going to be the current P&I field. Reason being is that Workout Prospector is actually going to calculate the non-interest-bearing UPB or the forbeared UPB for the payment deferral based on the number of months delinquent times the current P&I. So we want to make sure that we have the correct P&I value in there. And as I mentioned before, if anything is entered incorrectly, as long as the loan's still in draft status, you can make any edits you need to in order to get that correct P&I value, which would then flow into the forbeared UPB field. And then once you've completed this screen, you would hit save and then next. And that would bring us to the modeling attributes screen. So in this example, for the COVID-19 payment deferral, we only have delinquent interest being capitalized on the loan or on the payment deferral. With the COVID-19 payment deferral, you can also have legal fees and costs, property preservation, escrow advances that are going to be deferred on the loan or on the payment deferral, excuse me. Basically, anything that's allowed to be capitalized under flex modification can be deferred for the payment deferral. But I did want to just point that out. Obviously, this example just has delinquent interest. One thing to make a note of as well with the delinquent interest for a COVID-19 payment deferral, and again, the WP user guide as well as some guide bulletin updates that we've released have referenced this, but we want to ensure that for any borrowers affected by COVID, we're using a delinquent interest calculation off of a declining UPB, essentially based off the amortization schedule, as if the borrower was making their payments during the delinquency. So we want to ensure that we're in line with the CARES Act there, making sure that interest is accruing, or we're not charging delinquent interest more than what's accruing as if the borrower was making their payments. So I did want to just point out that highlight there with the delinquent interest. You could save that field once you've inputted all of the cap and arrearages. And then you would scroll down in the modeling attributes screen. And you're going to come to your hardship reason section. Now, it's pretty crucial for the COVID-19 payment deferral that we select the National Emergency Declaration as the hardship reason. Reason being, this aligns essentially with our EDR hardship reason as well. For any COVID affected borrowers, we're using the National Emergency Declaration. And then also, we want to ensure that we have a workout decision date and Workout Prospector as well. So for this example, the borrower was decisioned for the payment deferral on August 15th, 2020. And once we have the hardship reason selected and the decision date entered, we would submit for calculation. And that would bring us to the modification solution screen. So essentially, we're on our third screen now in the Workout Prospector model. And so we're going to just look through some of these fields sort of step by step. So in the loan attribute screen, essentially these are all of the values that the servicer has entered thus far under the current section. So servicers inputted 4.625 as the interest rate, 288 months as the remaining term. We have our UPB, and then the servicers also entered that P&I payment amount from the mortgage attribute screen. So this screen is essentially pulling in all of the data that the servicers already entered in Workout Prospector. The one thing I did want to point out here, and that is that this is also highlighted in the WP user guide is that the remaining term can actually be disregarded. This is just a WP calculation looking at the first payment due date to maturity date. So that's just something to make a note of here, that WP is automatically calculating something on the back end, but it can be disregarded. The one thing that I would say we want to confirm is that the maturity date, if you can see in the bottom right-hand corner of your screen here, we want to make sure that that is the correct maturity date. So the remaining term in months, that won't have any effect on the maturity date, but you do want to ensure that that maturity date in the bottom right-hand corner here is correct. If you can also see, there's another arrow highlighting the total arrears. So this, again, is just the delinquent interest that the servicers entered from the modeling attribute screen. It is now flowing into the total arrears field, and that's how we now have our new gross balance of $166,917.78. Just two other fields to note, obviously, that we want to make sure are correct are the forbeared UPB field and then the gross UPB field. The gross UPB is just the sum, obviously, of the interest-bearing UPB plus the forbeared UPB. But as I pointed out earlier, we want to make sure that the P&I amount on that first screen, the mortgage attribute screen, is correct, so that Workout Prospector can do the delinquency calculation, number of months delinquent times P&I payments. That will get into the forbeared UPB field. And then we would actually scroll to the bottom of the modification solution screen. And once we've confirmed that everything in the model is correct, we would want to put the loan in modification program approved status. So we've received, if the servicer, if you require a payment deferral agreement to be signed by the borrower and returned, you would enter that signed document receive date in this field. If you do not require a signed payment deferral agreement from the borrower, you would just enter the workout decision date. So for this example, we're using the workout decision date of August 15th, 2020 as that date, and then we would select modification program approved status under that modification status field. We've confirmed everything is correct, so now we're going to select Save Solution. All right, so we've saved the model. We've put the payment deferral, the COVID-19 payment deferral in modification approved status. Now we just need to enter in a couple more pretty simple borrower information data, as well as servicer contact information, and if applicable, some comments. So in the borrower section here, pretty simple information, just need borrower first and last name and the property address as well. Those would be the required fields. Once we've entered that, we would go to the contact screen. And I do want to point out here one pretty important field that we want to have updated. Now, if you've ever settled or submitted a workout for approval in WP before, or settled a workout in Workout Prospector before, your contact information should flow in to Workout Prospector. However, we want to make sure that we have a valid email address in the contact screen. This allows us, in the event that at settlement, if there's any information that Freddie Mac we might need clarification on, we can reach out to the servicer to confirm any information that we might need to double check on. So just want to point out that trying to save an email address in Workout Prospector is pretty crucial in the event that we need to have a quick conversation on just maybe some of the information that's been entered into WP. And then once we've put in the email address, we would go to the comments screen in Workout Prospector. And again, for a delegated payment deferral submission, completely optional if you, the servicer, want to enter anything in this screen. However, if you're submitting a non-delegated COVID-19 payment deferral for review, this comment section is the area of Workout Prospector where you would want to essentially submit your write-up for why Freddie Mac should consider this non-delegated approval for the COVID-19 payment deferral. Once you have completed your write-up, you would select Save, and then the comment would save to this comments box in the bottom. And then if we're going through a delegated COVID-19 payment deferral, we would go to the final screen in Workout Prospector, the loan mod settlement screen. All right. So this is the last step here in settling the COVID-19 payment deferral, is in the loan modification settlement screen. If you've ever settled a flex modification, it essentially mirrors that screen from the flex modification path as well. So as we've entered in information into Workout Prospector's model, we've saved that information, we've put the loan in approved status, we now have the loan modification settlement screen. And the loan modification settlement screen is simply just a reflection of all of those data inputs that the servicer has entered throughout the Workout Prospector model. So we'd want to confirm that all of the information in this field is correct. Once you've confirmed that this information is correct, we would select I agree, and then you would submit the payment deferral to Freddie Mac for final settlement. Once you submit for final settlement, you'll receive a message in red font on this screen that says settlement complete. Please review your manager series reports for updates. That would essentially be your check that, yes, this loan has officially been submitted to Freddie Mac for settlement. In the event that there is a warning message in Workout Prospector when you select submit, that warning message will also be in red font right under that loan modification settlement header. And once you double check the information in the screen and you confirm that it is correct, you can select the manual settlement review button in the bottom right-hand corner of the screen, and a Freddie Mac settlement specialist will review the loan for settlement. So I know that was a lot of information. Are there any questions on the COVID-19 payment deferral submission in Workout Prospector?
Great. Thanks, Gavin. So if you do have any questions, go ahead and select the raise hand icon located on the right side of your screen, or feel free to type in your question via chat. Looks like we have a question from Kelly. Kelly, your line is open. Hey, Kelly. All right, we'll come back to you, Kelly. Looks like we have a question from Mark. Mark, your line is open.
Yes, hi, thank you. Okay, so we also listened to the Workout Prospector webinar yesterday and this one today, and they're similar. Our question is, in this example, are we actually capitalizing the $6,000 onto the $160,000 balance? And now we're reporting a gross balance of $166 to Freddie with that $8,000 deferred amount and giving us the net $158. Are we supposed to physically increase our loan balance on our system?
So yes, that delinquent interest amount would go into the interest-bearing UPB portion of the balance.
Okay, so it's similar to actually a flex mod or a modification where we do increase the balance on our system and report a higher balance. And yes, we're going to then report net deferred as well, but we were unclear as to whether we were supposed to actually adjust up the balance.
So yes, the balance would increase based off of this $6,000 amount. And then just like a flex modification, as you alluded to, you would receive a credit once the payment deferral settles for that balance increase. That would be what's called an F1CI credit that posts to your detail adjustment report. So that cash adjustment process would work similar to the flex modification.
Okay, so then once we've settled this, we're now reporting, or we're telling the borrower, hey, your loan balance is now $166,000, correct?
So that would be the gross balance, correct?
Right. Do we need to do modification documents?
So there is a payment deferral agreement that needs to be sent out. However, I believe it's optional for the borrower to actually have to execute it and send it back. But there does need to be
Right, but this isn't something that we need to send to be recorded because we've now adjusted basically, the balance owed.
Hey, Gavin, it's Ben Gottheim, Servicing Policy at Playback. I'll take that one. So we don't say no to recording, but generally you should never have to record a payment deferral. So the only real purpose of recording a loan modification, which means you'd have to have the documents, you'd have to have the borrower sign, it would have to be notarized, returned to you, and then recorded, would be to comply with certain state laws regarding loan, regarding a modification in the act. The first lien priority of the mortgage. We don't believe that the payment deferral has that same type of impact. However, if you're working with your local counsel and they might think that a specific case could, you may have to, but I would venture a guess that you'll never have to record a payment deferral. And I think that's a very important, piece from one of your earlier questions about differences between, a modification and the payment deferral. That's where, in terms of what Gavin's talking about and the settlement and, kind of the operational nature of it, they're very similar. A payment deferral acts very similarly to a loan modification. We just don't call it a loan modification, kind of for the purpose of what you just described, in that, we don't need to have the borrower sign it and we don't need to have it, notarized or recorded. That's really where the difference in the naming convention is. It's not an operational difference between the payment deferral and the loan mod.
Okay, and that's great. We'd prefer not have to go through that. Our big thing was we wanted to make sure we understood that we were adjusting our loan balance, reporting a gross higher balance to you, and having our system have a lower, interest-bearing amount that the borrower is paying on. So we just needed to make sure we understood that, and we do now. Thank you very much.
This is John Felix from Servicing Operations, Investor Reporting at Freddie Mac. So just keep in mind, there are two balance fields that you do report to us. There is the interest-bearing UPB, and we do have the non-interest-bearing UPB. That's part of our loan level file. So these two fields will be reported to us required to be reported to us on a monthly basis.
Right, and we have some old HAMP loans that's got deferred.
Yep, very similar. Very similar.
And right, okay, so yeah, we set up our system just like we did those.
Yep.
Okay, thank you.
Great, thanks, Mark. Next question that we have comes from Kim. Kim, your line is open.
John just answered my question because I was a little confused when we were talking about capitalizing. When you use the word capitalizing interest and are capitalizing the previous caller said we were capitalizing, so that threw me off. So this is just merely in reporting. We still really have two buckets. We're really going to have interest-bearing UPB, then we're going to have the non-interest-bearing UPB deferred amount, which is going to be the full P&I along with other advances. And then you add those two as far as gross UPB. I get that. But where does capitalization enter into this scenario? So I got a little confused because in my mind, capitalization means we're going to put something on the gross UPB and that's it as far as on my lender side. But is that just a misuse of the word?
No, this is Ben. It's not. It is capitalized because it becomes UPB. Any of the arrearages turn into UPB. It's not interest-bearing UPB, but it is UPB. Similar to a flex mod that has, where the LTV is above 100%, and there's a non-interest bearing component to the overall UPB, and there's a UPB1 and UPB2, or an interest bearing and a non-interest bearing, as John just talked about, but it still becomes UPB, hence capitalization.
Okay, so in our system, we were thinking of doing a deferred principal and keeping that separate, and then also in another bucket, if you will, the delinquent interest. They're both going to be in non-interest bearing scenarios. But in this scenario, I don't know how I would then capture my reporting to you. So that would mean I would have to manually then add my P&I and manually update my gross UPB then for this scenario? Because I'm not doing it on my system. I'm actually reducing my
interest-bearing UPB. You're reducing
right.
your interest-bearing UPB, and then you're creating a non-interest-bearing, or potentially adding it to an existing non-interest-bearing UPB if it's an old HAMP loan or a flex mod. So yes, you're still going to have two separate UPBs to track, one that has an interest-bearing component and one that does not. But it is still all UPB.
So when I'm doing my reporting on the non-interest-bearing UPB, is that my P&I combined and along with my advances?
I'm sorry, your question is your non-interest-bearing UPB the amount that was previously a mixture of past due, principal, interest, and other advances? Is that's your question, right?
Yeah, because you have on here UPB.
Yes.
Okay. So because in my mind
the example Gavin went through, right? In the example Gavin went through, there was, I think in that example it just had principal and interest, but that was in arrears, and then that becomes the non-interest bearing balloon or the deferred UPB.
Okay, so I guess I'm going to say it one more time, and then so you're going to want the combined interest, advances, and the delinquent principal portion of the payment is to be in your reported forbeared UPB.
John, you want to confirm that?
Yeah. Yes. Your non-interest bearing is going to be, as we said, any of those missed payments. Just say if there was 4 or 5 missed payments, that payment. Then if you had any taxes and insurance or any corporate advances, they all get lumped in, and now they are considered the non-interest UPB amount. So it's going to be the total of those.
Okay. All righty then.
Great. Thanks, Kim. Next question that we have comes in via chat. So where do we input the principal that was part of the payments that were forborne?
So for that, you would just, we're just including the total P&I amount in that first screen in the mortgage attribute screen. We're taking the total P&I amount, and then we're multiplying that by the number of months delinquent, and that should get you your forbeared UPB. So there's no separation between principal and interest in Workout Prospector. It's just total P&I.
Okay. Next question. Can we forbear the escrow portion of the missed payments? If so, how can we do that? Go ahead. I'll go ahead and just repeat. Let me go ahead and repeat that. Yep, sure. Can we forbear the escrow portion of the missed payments? If so, how can we do that?
Got it. This is Ben, and I'll ask anybody else to join me if they'd like. I know this is a question we had dealt with a number of examples on this call over the past several weeks. In other calls we've gone through an example of that as well. The escrow portion of the missed payment. So it's I'd love to give you a simple yes or no. The answer is yes if it was advanced, and by advanced I mean yes if you actually physically paid those amounts to the taxing authority or the insurance company or whoever you're aggregating the installments for, then it is part of the mortgage debt. You can include it here. If it's simply that the borrower missed, when they missed a couple of their payments under a forbearance. They also didn't pay the T&I portion of their payment, yet those escrow payments have not actually become due yet, then no, it cannot be included in the foreborne amount. And that's because those payments are not past due because they've yet to be due to the authority that you're collecting them on behalf of the borrower. So there, you collect escrow amounts in advance of the payments actually becoming due to the taxing authority or the insurance company or the HOA or wherever you're collecting it for. They're not actually past due until the payment's actually missed.
Got it. Thank you. Next question that we have comes from Paul. Paul, your line is open.
Appreciate the time, guys. Thanks. I just have a two-part question, if you don't mind. Curious, typically in Workout Prospector, if a loan had not been delinquent before or prior, there would be a pop-up message when you input a loan number that says the loan will be available tomorrow. There'd be like a 24-hour time lag before you could enter in the information. I'm just curious, do you know if that's still going to be the case with these payment deferral loans on loans that have never really been late before?
Yeah, so it would still give you that warning message that we're going to pull the information from the loss mitigation system.
Okay, excellent. Thank you for that. And then my last question, if a situation where it kind of ties into EDR, this question. So I have a situation where the borrower has been current all along, and he's asking for a 1-month deferral for the month of July. And my question is, am I able to process that this month, or would I have to wait till next month for it to get reported through EDR, which essentially could possibly be a 2-month deferral? So I was just curious if any of these had to be reported through EDR, if they were just having a 1-month deferral, if that makes sense.
So from a Workout Prospector standpoint, we would obviously want the payment deferral to be finalized before we actually begin settling. From an EDR standpoint, if the loan is delinquent, we do want that COVID hardship in EDR as well.
Yeah, so in this instance, they're not delinquent, right? He calls me July 1st, says, listen, I can't make my payment this month. Can I defer it? He was never delinquent. My question is, can we process that during the month of July so that he effectively would be due come August 1st for August 1st?
So no, they would actually have to miss the July payment in order to get the 1 month of July deferred.
Okay, that was my question. Thank you.
And Gavin, I'll add on to that. Just remember, forbearance is the proper program, or I'm going to call it a program for somebody who cannot make their payments for whatever period of time it is. 1 month, that's fine. That's what a forbearance is for. It's a temporary reduction or suspension of payments. Payment deferral is a program that is typically going to be at the end of the forbearance when the hardship is resolved. It's specifically for the hardship to be resolved. And I think as you're having conversations with, your customers, your borrowers, when it is that, you can let them know, no, I can't do the payment deferral today, but that is something we can talk about once you're back on your feet and we can confirm that this is the right time for you to resume making your payments. We've been asked a lot of that over the last, few weeks, months of, if somebody knows they're going to have their job back in 3 months, can I just approve them for the payment deferral right now? And the answer is no, because is anybody really going to have their job back in 3 months? And we don't want to do it where we've now given somebody a payment deferral and they go right back to being delinquent because it wasn't the right thing to do. So you can let them know, you can talk about with them, you just have to let them know the right time to actually enter into the payment deferral is when we can confirm with you that you are back on your feet and can afford the payment.
Okay, thank you.
Great. Next question that we have comes from Brian. Brian, your line is open.
Thanks. I just want to confirm on the screen we have here for the forbeared UPB, if the borrower had prior forbearance, is the number we enter here the sum of the two balances, prior and deferral, or just the new deferred balance?
So So it should be the sum, if there was a prior forbeared UPB on the loan, it should be the sum of the prior forbeared UPB plus the new forbeared UPB in this field.
All right. Thank you.
Great. Next question comes from Helena. Your line is open.
Yes, thank you. My question is regarding once the Workout Prospector is completed and submitted and approved, the reporting part through Service Loans Gateway, will this be a manual process, or will the extract, if it goes through the extract, once we fix our system to what the prospector is telling us to fix, will the extract create an error, and will this have to be done a manual entry? Because yesterday's workout, it seemed like we would have to enter the loan like singular, manually, then hit that it was a deferral payment reporting. Can you confirm that?
So is this in regards to like the loan level reporting after the settlement of the payment deferral?
That's correct. And then now we have to report it through, the Service Gateway. Normally we do it through the extract file, but on the brand new loan that becomes approved, does that have to be entered into the Service Loan Gateway manually?
So I think that's probably a good question for our investor reporting group. I don't know if we have that answer right now, but we can definitely take that as a take back.
Let's take that one back, and we can circle back with you on that question.
Okay, thank you.
Great. Thank you, Helena. Next question that we have comes from Joe. Joe, your line is open.
Yes, on the taxes and insurance being able to, or advances being able to move to the non-interest bearing account, does that include private mortgage insurance that's paid out monthly?
Sorry about that. Yes, it does. So anything that you've advanced, right, anything that you're collecting in an escrow, you've advanced on behalf of the borrower hasn't funded it, you've had to pay it on their behalf, then yes, it would be included in here.
Okay, so pretty much the time from the time they're delinquent up to the modification or the deferral, basically.
Yeah, and
okay.
The way to think about it is, what can be put into that forborne UPB is going to be any amount that, think of it like a payoff. Think of it like you're generating a payoff statement, and it's that delta or the difference between what your UPB is and what the total debt is of what what you would give the borrower on a payoff statement. That's what's going to become the forborne UPB.
Okay, and all of this goes into kind of one balance, basically.
Yes.
Okay, is there a rule on when if they get to a payoff point, is there a rule on like how soon they have to pay off that UPB, non-interest bearing UPB, or do they start paying it down before they get?
It becomes due at the earliest payoff or maturity.
Okay.
So it wouldn't be due. So if they can make their payment, it would be due at the last month's payment. More likely than not, they'll pay off early, whether it's their sale of the property, refinance, whatever the case is, and it'll be part of the balance at that point.
Okay, but if they defer 6 payments and they got basically 6 months of payments not non-interest, and they down to maturity, you're expecting them to pay that entire thing off. Then that's the expectation anyway.
That is the expectation, and we have a lot of modifications that have the same type of non-interest bearing balance with that as well. And
okay.
if you do get to that point, years down the road, and we need to have those conversations about what to do if the borrower can't resolve it. I'm sure we'll have ways to address it at that point.
All right, thank you, sir.
And Ben, this is John. I would just add to that. It would seem maybe odd, but on that non-interest-bearing UPB, we do have a field that if for some reason the borrower wanted to start paying down the non-interest-bearing UPB, there is a principal field for the non-interest-bearing UPB that if they made their the payment deferral settles, they're making their monthly payment, and they want to apply $100 to that non-interest bearing, there is a field in our loan level file. If for whatever reason they felt as though they want to do that, they can do that.
Okay. Thank you.
Great. Next question that we have states, will this process have to be done every month until the note matures?
So no. From a settlement standpoint in Workout Prospector, that's just a one-time deal.
Great. Thanks for confirming. Next question that we have comes from Connie. Connie, your line is open. Hey, Connie.
Hi, hello. I'm sorry, I just unmuted myself. Can you hear me?
Yep, we can hear you.
Okay, perfect. I have two questions here, actually. I had typed it out on the Q&A too, but let's just go over the first one. It's in regards to the escrow advances. So just wanted to clarify. So in a case, for example, where the escrow balance had partial funds available, but not enough. So it had funds available, but not enough to cover the full bill of their taxes or their insurance during the forbearance plan. So therefore, we've used up all of their available funds in their escrow balance, plus we've advanced the other half to fulfill the actual total bill. So are we deferring our portion of our half that we've put in to satisfy the entire bill?
Yes. So to use an example with numbers, if the overall the tax bill is $2,000, the borrower had previously funded $1,000 into their escrow account, the taxes come due, you have to pay the $2,000, meaning $1,000 came out of your pocket. That $1,000 becomes part of the mortgage debt, and it would be what gets added into the foreborn balance.
Got it. Thank you. All right. And my next question is, I'm coming from just fresh out of, beginning the Fannie Mae deferrals. I just wanted to clarify with when it comes to Workout Prospector, if, for example, an account had a forbearance from April through June and they can resume making payments effective July. In Workout Prospector, we're merely just calculating those April through June delinquent interest. And then once we submit and settle on all of that, the payment effective or the deferral effective date will be July 1st, which is the actual date that the borrower can resume making payments coming out of the forbearance. Is that correct? Is that how Workout Prospector is going to process the deferrals?
So with payment deferrals, the evaluation can't begin until July 1st, so your effective date at the earliest would be July 1, and then the first payment due date under the payment deferral would be August 1st.
Got it. Okay, so then it's very similar or the same with the Fannie Mae process, where if a borrower can resume making their July payments and want to come out of the forbearance, and we've gotten their July 1st payment, if they don't want to defer July, we'll have to apply that July to April and then recalculate the total interest and then submit to Workout Prospector like this. But to the borrower, it will be a seamless payment process and paying process for them because they've already paid July, and then they'll just resume making their payments with August and so on.
Correct. So the P&I is going to stay the same. So if they made their July payment, then they would continue on and make their August payment as well.
Okay, and then but Workout Prospector will show that the payment deferral effective is August 1st.
It would be July 1 if that's when the borrower was put on the payment deferral. So earliest it would be is July 1st for the effective date, or as NWP, the interest rate change date, and then your first payment due date would be August 1st.
Got it. Okay, so it's very similar to Fannie Mae's process in the end, if you're familiar with Fannie Mae.
Yeah, similar, just slightly better.
Okay, thank you. Thank you for the clarification.
All right, next question comes from Dawn. Dawn, your line is open.
Hello, everybody. I have a question in regards to when we might need to use the reimbursement system. Do we file to reimburse for certain things like legal fees and costs, property preservation? Do we put any of that information into that system, or is it really all done through Workout Prospector?
So for property preservation or any escrow advances, if you're deferring those in the non-interest bearing or the forbeared UPB or the payment deferral, there's no need to go into the reimbursement system for that. You would get that, you get an adjustment, essentially, a cash adjustment from Freddie Mac, a credit for the advance, either for property preservation or escrow advances, as long as that's obviously entered into Workout Prospector. Once you actually settle the payment deferral, you'll get that back as a credit.
Okay, and then kind of part two to that similar question. With the difference in interest between what has actually been assessing and what we've been paying and the declining interest per CARES Act, how does that get reimbursed? Is it also reimbursed through the DAR credit, or?
Yep. So if you're for the delinquent interest portion that's getting entered into Workout Prospector, that's going to also be included in what's called an LMCI credit, and that will post to your detailed adjustment report, or also known as your DAR.
Okay, wonderful. All right, thank you, guys.
Hey, it's Ben, guys. I just want to add one just nuance, just to make sure that it's clear. First, hopefully, since for these COVID-19 payment deferrals, the borrower had to be current, or at most one payment past due at the time of the emergency declaration. So hopefully, there shouldn't be too many of those foreclosure or property preservation type expenses that are out there. Certainly make sure they didn't get incurred during the forbearance, or else you're going to have some other issues. But if they are, they can, as Gavin said, they can all be included in there. There is one minor exception to that, and it was a question that was brought up a little bit earlier on this call too, which is in the event there is ever one of these far-off scenarios where you do wind up recording a payment deferral. In those cases, we do have a few expense types that we don't allow to be capitalized. They are, the property valuation, the notary expense, the recordation expense, and any title work. So in the event those do happen, you would go through the expense reimbursement system to get that amount of money back at the time of payment deferral. But frankly, it should never happen on the payment deferral. But if it ever did, those are expenses that you go through the reimbursement system.
Okay, so recording and possibly title expenses.
Yeah.
If we went down that path, those would go through the reimbursement system.
Yeah.
All right. Thanks again.
All right. Next question that we have comes from Matt. Matt, your line is open.
Oh, hi. I actually had a few questions. The first being, so I'm assuming that if we were doing a 6-month extension, for example, we're extending the maturity date by the same number of months.
So no. With the payment deferral, the maturity date is staying the same. As we were going through this example, this remaining term field in WP for the payment deferral can actually be disregarded, and the user guide will point this out as well, that this field can be disregarded. The maturity date on the loan from basically pre-payment deferral to post-payment deferral should stay the same. So there's no term extension.
I see. Okay. Thank you for the clarification. My next question would be: Is there a standard Freddie Mac deferral form? Similar to the loan modification form.
So I believe there is a standard template. Yep.
Yeah, we do have a model template. You don't have to use it, but we do have one out there. And I see we have a few minutes left in our call, so I don't know it off the top of my head, but I will search for it while we take the next question and come back. It's in our guide. It's one of the exhibits. I'll name it out just in just a few minutes.
Okay. No, I should be able to find it. I just wanted to make sure. I guess my other question would be regarding escrow advances. So my understanding is, regardless of what escrow advances need to be paid, they're added to the principal balance, but essentially we're not increasing the interest-bearing principal. We would only be capitalizing on the non-interest-bearing principal. Is that correct? Any advances or delinquent interest?
So for the escrow advances, that would go to the non-interest-bearing UPB or the forbeared UPB, which would in turn increase the gross UPB on the loan.
Of course. So with that being said, I mean, that is, regardless of whether we're increasing the interest-bearing or non-interest-bearing UPB, to me that would be, that's a modification to the loans. I mean, I think we would have to have the borrower sign a loan modification agreement, since we're increasing their obligation on the principal.
We don't. This is a tough question because I'm certainly not a lawyer or your lawyer. Our opinion is that is not the case. That being said, we don't prescribe the law or tell you how to follow or comply with the laws, especially any local or state laws. So I would think you work with your attorneys on that. We don't think that has to be done. That being said, if you work with your attorneys and you believe, yes, I need the borrower to sign it for this reason, you get to make that decision. But if you make the decision that you also don't need to have the borrower sign it, you are in full compliance with our requirements, which is different than a loan mod, because loan mod, we absolutely make you have the borrower sign it.
Of course. Okay.
And while you're still here, just real quick, I apologize, we don't have it's not a specific exhibit number for the COVID-19 payment deferral. It actually, we just did it as an attachment A to our bulletin 2020-21, which is the bulletin that we announced the COVID-19 payment deferral. So there is an attachment with that bulletin that has a sample payment deferral agreement.
Okay, thank you. I guess my last question, just in regards to the non-interest-bearing UPB, so that's going to be basically, let's just say it's, I don't know, $2,000. Essentially, that's deferred principal that they would owe at the end of the term, correct?
Correct. So they'd owe it at maturity or pay off, whatever happens sooner.
Of course. Okay. All right. Thank you.
Great. Thank you. Next question that we have comes from Maria. Maria, your line is open.
Hi, can you hear me?
Yep.
Okay. I have just two bits of that I'd like you to clarify that I heard other speakers speak. There was one gentleman who talked about having this customer defer for 1 month. I thought that there was, for these deferral mods, a minimum of 3 months. Is that correct?
No, there's no minimum.
There is no minimum?
No, but there is a maximum of 12 for the COVID-19 payment deferral.
I knew there was a maximum, but I thought I read there was at least 3 months. Otherwise, there would be other options for less months. But okay, so it's good to know. So 1 month, you could still do the deferral mods for 1 month.
Yeah, but you may want to confirm, in the event that there is just a 1 month delinquency, it may make more sense to maybe see if that borrower can reinstate first. And then if they can't, then maybe they could be reviewed for the payment deferral option.
Okay. The second question that I heard, and I wanted clarification, was I was told, I don't know if in this webinar or a different one, and an earlier one, that they couldn't pay toward the forbeared balance, and I just heard that they could. I thought that had to be done at payoff or maturity only, that they couldn't be paying that down along the way.
And this is John from Investor Reporting. So we do have a field that's available specifically for that purpose. If a borrower, like I was saying, if they, now we settle this, they're current, I'm just making it up, they're making their September payment. If they chose to make a curtailment, it would only really be a curtailment against that because it's just a principal balance, right? It's not interest bearing. We do have a field that is available. If a borrower, again, it's non-interest bearing, you might want to think, why, if you take that, don't want to tell them what to do or tell you what to tell them to do, but take that $100,
put
apply
it toward the interest-bearing.
Yeah, why would you
right?
put it in interest-bearing? Yeah,
I agree.
so,
I totally agree.
We made that available because we had, earlier on, even with the Hampton, people said, we may need that because someone might want to do that. So it's there. It's an option. They can do it.
A customer did specifically ask that, and I told our special assets department, I kind of said, no, that's done at payoff. I said, because it's better for them to put it towards the interest bearing. Like, why wouldn't they put it toward principal instead?
Right. So yes,
okay.
you can make it, and we have that field there for when you report if they chose to do it.
Yeah.
Okay.
Yeah. So guys, both are right. Both are right. So I'm sure in the webinar that you went to with our training department, they went through our policy. Our policy says you must apply it to the interest-bearing UPB first. However, there are always exceptions in life. There are always exceptions in mortgage servicing. You may have one of those borrowers who says, I don't care that it's worse for me. I want it this way. And, we have, as John said, we've created a field to be able to do that.
Okay.
Now, with these ones, it probably shouldn't happen too much. We need to go back to the old, the HAMPs from a decade ago, the HAMP mods that had, very large forborne balances. Some borrowers really did want to be able to start paying that down because they were really worried about what might happen at maturity.
Okay. Sounds good.
Great, thank you. Now we're pretty much almost at time. I do want to take one more question that comes from Yvonne. Yvonne, your line is open.
Actually, my question got asked by somebody else, so I already got my answer.
Oh, great. I do say that there's a few other chat questions in there. Again, we'll take it back, and they'll be a part of a larger FAQ document possibly. So with that, I know, Ben, you wanted to go over some resources that we have available.
Yep, absolutely. Thanks, Baha. So, in addition to these calls, which we love to have with you guys, we do have actual, training webinars with our training and dedicated staff, and they're a couple hours long to really delve into a lot of these different things. So, up on your screen, you'll see three different webinars that are coming in the month of July in the different times and the links. I don't think you can click on this because it's not actually a hyperlink, but I do think we make that available somewhere. So we have our COVID-19 relief webinar, eligibility and forbearance. That's all things COVID-19 in the policy space. Our COVID-19 relief regarding payment deferral and flex modification. That's a lot of the stuff that you just heard here, in addition to the underwriting of those programs. And then, similar to what Gavin just went through here, is the Workout Prospector for Payment Deferrals webinar, which is a webinar dedicated to settling workout, payment deferrals and Workout Prospector. So, please make sure you're aware of the trainings, the webinars that we have, and if you have the opportunity to take advantage of them, please do so. Additionally, we have some key resources, as you can see on the screen as well, a number of our guide bulletins. We have a couple of scripts that we have put up on our website as well. Our Servicer ebook, which is a really great resource to use for a lot of high-level information, as well as our reference guide and our payment deferral webpage. So, again, I'm not sure you can click on these links, but we're trying to make as much content available as possible. Please provide us any feedback on the content if there's something that we're missing that you think we need, and take advantage of the resources available. So. With that, Baha, I think I'll turn it back to you for the Hold
Yep.
on.
So thanks, Ben. And just to let the folks know as well, we'll be sending out, again, that weekly email, and the presentation will be included. So those hyperlinks should be able to work for you as well, so for easy access. So with that, I'm going to go ahead and turn it over to Don for closing remarks.
Thanks, Bob. And thanks, everyone, for participating, especially our panelists. Gavin, Ben, and John did a great job answering the questions. I just want to reassure everyone that we will continue these sessions as long as there's an information need out there and you still have questions. So we look forward to seeing you or speaking to you next week. Thank you again.